This is Lagos, the center of excellence, and this is a market in Lagos. Every day, millions of Nigerians earn their livelihood in this informal economy, from market traders and artisans to transport operators and home-based businesses. According to the National Bureau of Statistics, the informal sector of Nigeria, which includes markets like these, accounts for over 60% of employment and contributes approximately 65% to Nigeria's GDP. Despite this, the informal sector barely contributes to Nigeria's tax revenue. While the government has implemented multiple tax reforms and automated systems through the Federal Inland Revenue Service and various state boards of internal revenue, the informal sector's compliance rate remains low due to structural, social, and administrative hurdles. In this video, we will explain the unique challenges that hinder tax compliance in the informal sector and propose actionable strategies to address them. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. What is the informal sector in Nigeria? The informal sector refers to economic activities that operate outside formal government regulation, often without registration or licensing. It includes market traders, artisans, street vendors, transport operators like Okada, riders, and danfo drivers, smallholder farmers, and home-based businesses. The key defining characteristics of the informal sector include 1. Unregistered operations. Most businesses operate without formal incorporation or registration with the Corporate Affairs Commission. 2. Limited use of financial services. Transactions are predominantly cash-based with minimal reliance on banking or digital payment systems. 3. Inadequate bookkeeping. Many businesses lack structured accounting systems, making financial tracking and tax assessment difficult. 4. Non-standardized operations. Business practices are often guided by community norms rather than formal regulations, leading to inconsistent structures and compliance. While these characteristics allow businesses in the informal sector to operate with flexibility, they also present significant challenges when it comes to tax compliance. Compliance challenges in the informal sector: lack of awareness and education. Many informal operators have little or no knowledge of tax laws, available incentives, and how taxes benefit their communities. As a result, tax literacy remains extremely low within this group. Weak institutional coordination. Poor collaboration between regulatory bodies such as the Federal Inland Revenue Service, State Board of Internal Revenue Services, Corporate Affairs Commission, NIMC, and financial institutions leads to inconsistencies in taxpayer identification and tracking, making enforcement efforts ineffective. Record-keeping deficiencies. Without structured records, it is difficult to determine taxable income, making assessment and audit efforts challenging for authorities. Complex and burdensome tax system. The overlapping layers of taxation, including local government levies, market dues, and environmental taxes, create confusion and discourage voluntary compliance. Low trust in government. Widespread perception of corruption and mismanagement of public funds lead informal operators to question the value of paying taxes. Perceived risk of formalization. Many small business owners fear that registering their businesses will expose them to excessive regulatory scrutiny, financial burdens, and even harassment from government agencies. Despite these challenges, several strategic measures can help bridge the gap and encourage tax compliance among informal sector businesses. Strategies for improving informal sector tax compliance. 1. Simplified tax regime, presumptive taxation. Nigeria can strengthen the implementation of presumptive tax regimes where tax is assessed based on visible indicators such as business location, size, or type. 2. Adoption of technology and mobile tax platforms. Mobile technology can be leveraged to register, assess, and collect taxes, similar to Rwanda's e-tax system and Kenya's mobile money tax initiative. Nigeria can scale platforms like Tax Promax for simplicity and accessibility at the grassroots. 3. Grassroots tax education campaigns. Public awareness efforts using local dialects, radio broadcasts, market sensitization programs, and visual storytelling can enhance tax literacy. Partnering with religious organizations and trade unions can also help expand reach. 4. Incentives for voluntary compliance. Providing tangible benefits such as access to government grants, fast-tracked business registration, tax amnesties for new registrants, and priority participation in markets and trade fairs can encourage informal businesses to register and comply. 5. Collaboration with associations and cooperatives. Tax authorities should formalize agreements with informal sector associations to use a peer enforcement model, promote self-regulation, and coordinate group tax remittances. Capacity building for tax officials. Training tax officials in behavioral economics, negotiation techniques, and data-driven assessment can enhance their ability to engage with informal businesses effectively. 7. Integration of identity and digital systems. Linking tax records with NIN, BVN, and business registration platforms can help improve identification and track income flows. Now, let's examine some case studies and comparative insights. Rwanda. The Rwanda Revenue Authority introduced an e-filing and mobile payment system for small traders, which significantly reduced compliance costs and expanded the numbers of taxpayers from the informal sector. Ghana. Through its tax stamp system, Ghana categorizes small businesses by sector and location, applying a simple flat tax model and issuing a tax stamp as proof of payment and registration. Lagos State, Nigeria. Lagos State Internal Revenue Service introduced presumptive tax regime for small businesses and e-tax platforms. Although adoption remains limited due to low digital literacy and resistance from operators. Policy recommendation. Institutional reform. Establish interagency tax forces between CAC, NIMC, BOI, and tax authorities to streamline taxpayer onboarding. Legislative support. Amend relevant tax laws to mandate simplified compliance procedures for micro and small enterprises. Data analytics and geospatial mapping. Deploy artificial intelligence and GIS tools to map informal economic activities and estimate potential revenue. Public expenditure transparency. Demonstrate visible use of tax revenues to build trust, such as funding roads, health centers, and schools in markets and informal settlements. In conclusion, taxing the informal sector in Nigeria is not just about revenue generation. It is a critical step toward inclusive economic development. The focus should not be on penalties but on fostering participation in the informal economy through trust, education, incentives, and innovation. By adopting a taxpayer-centered approach and using a mix of technology, policy reforms, and institutional collaboration, Nigeria can gradually integrate the informal sector into the formal tax net, ultimately expanding its revenue base and promoting national development. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.